Our new trade policy will also be great for the American farmer. I love the farmer. Who will now be selling into our home market, the USA, because nobody is going to be able to compete with you.
Our major export commodity, our number one agricultural commodity is soybeans.
The markets I lost personally, it averaged about between $50,000 and $70,000 a year for 4 years running. Well, roughly $250,000 that I lost under Donald Trump.
Soybeans. Data from the American Soybean Association shows the U.S. is losing out on billions of dollars in purchases from China, which spent over $3 billion on soybeans in the second quarter of 2024. So far has spent $0 this year.
Soybeans, once hailed as America's green gold, are now plunging into free fall. What was long considered a crown jewel of U.S. agriculture has turned into a liability, slipping off the global trade map with alarming speed. China, the single biggest buyer, has slammed the brakes. By September 2025, Beijing had not placed a single new order. Just a year earlier, purchases totaled 12 to 13 million tons. The silence is deafening, and the numbers tell a brutal story. U.S. soybean exports to China have collapsed by 77% after retaliatory tariffs. Futures have tumbled nearly 40% from their 3-year high, forcing farmers to sell at a loss. Silos across the Midwest are overflowing with unsold beans, dragging domestic prices to rock-bottom levels. The most chilling question remains: has America's green gold already lost its value in the very market that once defined its power? If the collapse looks devastating on paper, the reality in the fields is harsher still. For American farmers, this trade war isn't measured in neat percentages or market charts. It is lived through overdue invoices, harvest sold below cost, and the nightly stress of wondering whether the farm can last another season. Behind every statistic is a family weighing which bills to pay first and which machines can limp through another year without repairs. Soybean futures now hover around $10 a bushel, failing to cover the average production cost of $11. That gap might seem small, but when multiplied across hundreds or even thousands of acres, it becomes a financial sinkhole that swallows entire farm incomes. Caleb Ragland, president of the American Soybean Association, revealed that his own farm has absorbed losses of roughly $750,000, enough to force him into deeper debt just to keep operations alive. Stories like his are becoming alarmingly common. The IN 2024 alone, 216 family farms filed for bankruptcy, marking a 55% surge compared to the previous year. Rising interest rates magnify the strain, while higher costs for fertilizer, fuel, and machinery, much of it inflated by tariffs on steel, aluminum, and potash, push budgets past a breaking point. Farmers are now caught in a vice, shrinking revenues on one side, escalating expenses on the other. This combination doesn't just erode profit margins, it erodes hope. Across the Midwest, producers face hard choices, whether to downsize operations, lease out land, or walk away from businesses built over generations. What once symbolized the resilience of rural America now teeters on the edge of fragility. The weight pressing down on farmers does not come only from falling prices, but also from the very policies meant to protect them. Layer upon layer of tariffs have transformed what was once America's competitive edge, cheap soybeans, into a burden too heavy to carry. An additional 10% duty raised the total tariff rate to 20%. Combined with other levies, the effective barrier climbed to around 34%. For China, the math was simple. U.S. soybeans were no longer a bargain, but an overpriced risk. The world's largest buyer effectively vanished from America's order books, shutting off a lifeline that has sustained millions of acres. The shock is not without precedent. Between 2018 and 2020, U.S. agriculture absorbed an estimated $26 to $27 billion in losses, with soybeans carrying nearly $20 billion of that pain. Farmers still remember those years as a scar across the heartland. Yet what is unfolding now carries an even darker undertone. Many analysts argue this isn't a replay of the past. It is the same crisis returning on a greater scale, with fewer chances of recovery and even less room to maneuver. While American farmers scramble for footing, others have wasted no time stepping into the gap. Brazil and Argentina, long waiting in the wings, have emerged as the clear winners of China's shifting trade strategy. With Washington tied up in tariff battles, Beijing has quietly redirected its purchasing power southward. Chinese authorities have gone as far as instructing importers to halt soybean purchases from the United States, effectively shutting the door on one of America's most critical markets. The results speak volumes. In 2024, roughly 71% of China's soybean imports came from Brazil, while only 20% originated from the US, a reversal that would have seemed unthinkable a decade ago. The imbalance deepened in 2025. From January to July, China imported more than 42 million tons from Brazil compared with just 16.5 million tons from the United States. By October, South America had shipped an additional 7.4 million tons, meeting an astonishing 95% of China's monthly demand. For Beijing, the strategy is clear: diversify away from American supply and reward partners who can deliver without political strings attached. For Washington, the message is harsher. When one door closes, another competitor will rush to lock it behind you. The world's appetite for soybeans has not disappeared, but America's privileged place at the table may have. The crisis stretches far beyond the fields. It cuts into the very arteries of the American economy. Soybeans are not just another crop. They are a lifeline, anchoring jobs, trade balances, and the financial stability of entire regions. When that chain begins to break, the ripple effects are enormous. Analysts warn that if China continues to sit out until November, the U.S. could lose an additional 14 to 16 million tons of exports. That shortfall would not only drain farm income, but also reverberate across transport, storage, and processing industries that depend on steady flows of grain. Agriculture accounts for nearly 18.7% of U.S. GDP, about $9.5 trillion when all related sectors are included. Within that vast machine, soybeans alone are tied to more than 231,000 American jobs. Every lost contract doesn't just wound a farmer, it puts pressure on truck drivers, port workers, factory shifts, and entire communities stitched into the soybean supply chain. History makes the danger clear. In a previous trade war cycle, soybean-related damages consumed close to $20 billion. A repeat at today's scale could trigger a wave of bankruptcies, turning financial pain into a rural social crisis marked by unemployment, depopulated towns, and political unrest simmering just beneath the surface. The warning has not gone unnoticed abroad. Canada, though far from being a soybean superpower, has taken the current turmoil as both a cautionary tale and an opportunity to rethink its agricultural playbook. With production volumes only a fraction of what the U.S. can grow, Canadian farmers were never in a position to flood the Chinese market. Instead of chasing impossible scale, Ottawa has deliberately asked a different question. How can a small producer remain resilient in a world where markets shift overnight? The answer has emerged through a steady layering of safeguards and forward-looking policies. Agri-stability, once a modest safety net, has been expanded to cover up to 90% of losses, a signal that the government intends to shoulder more of the volatility so that family farms aren't forced to fold under sudden shocks. Alongside that, an additional $1 billion Canadian dollars in credit facilities has provided breathing room to refinance, invest, and adapt without being strangled by rising borrowing costs. These measures don't just mitigate risk, they instill confidence that the system won't abandon its producers when the storm hits. Beyond protection, Canada has also chosen to redefine its competitive edge. Rather than chasing bulk commodity exports, it has sharpened its focus on areas where smaller volumes can deliver higher margins. Premium pork for Asian markets, specialized pulses for health-conscious European consumers, and branded processed foods carrying the halo of Canadian safety standards have all become part of this strategy. By embedding reputation into higher-value niches, Canada reduces exposure to commodity price swings and strengthens its standing as a trusted supplier in markets where reliability matters more than volume. This quiet restructuring reveals a broader mindset. Canada is treating agriculture not as a numbers game, but as a test of long-term resilience. The shift illustrates a recognition that in the age of trade wars, flexibility may prove more powerful than scale. And while American producers find themselves cornered by reliance on a single buyer, Canadian farmers are charting a path that, though smaller in size, may be more sustainable in the years to come. In Washington, the response has followed a familiar script. When markets fail, write a bigger check. The Trump administration has once again turned to massive aid packages in an effort to cushion the blow for farmers caught in the crossfire. It's not the first time this playbook has been used. During the earlier trade war, more than $23 billion was funneled into emergency relief, a lifeline that many farmers remember as both necessary and insufficient. Now, history is repeating itself on a larger scale. In July 2025, the administration approved a sweeping $65 billion program stretched over the next decade, aimed at bolstering crop insurance and direct support for agriculture. Agriculture Secretary Rollins pledged that at least $10 billion would flow directly into farmers' accounts as immediate payments. On paper, the numbers look generous. In practice, many argue that checks from Washington do little more than buy time, leaving the underlying market collapse unresolved. The American Soybean Association has been blunt. No subsidy can replace lost access to China. Its leaders have pressed the White House for a swift diplomatic breakthrough. Yet as negotiations stall and retaliatory tariffs remain, the path back to normal trade appears murky at best. Relief money, they warn, is little more than a bandage on a wound that keeps reopening. Soybeans are no longer just an agricultural story. They have become a mirror reflecting the erosion of American power. Once a tool of economic diplomacy, a simple grain that carried U.S. influence into Beijing's negotiating rooms, soybeans now stand as a reminder how fragile that leverage truly was. With China tightening its embrace of South America, the door that once swung wide for U.S. exports may be closing for good. The implications stretch far beyond trade statistics. Losing soybeans doesn't just mean losing contracts. It means forfeiting a diplomatic instrument that for decades underpinned Washington's global reach. As rural America buckles under the weight of bankruptcies and lost income, the fallout risks igniting political discontent at home. The farm crisis becomes not just an economic wound, but a social and political wonder from one crop to an entire nation standing. The warning is stark. America's green gold may no longer guarantee a seat at the table of power. If even soybeans can slip away, what else could follow? Will the United States find a way to rebuild trust in global markets? Or is this the beginning of a longer retreat from economic leadership? The question lingers, heavy with consequences.